An introduction to financial modeling. What is a financial model? Well, there'll be many different definitions of a financial model. My attempt at a definition is that it's a forecast for a specific business of key financial information, usually done in Excel, that uses a set of assumptions in order to see the financial effects of decisions. So the purpose of a financial model is this final statement here, to see the financial effects of decisions. And the key elements of a model are that it's a forecast and it revolves around finance. So we're looking at financial information and we're looking at key financial information. Not all information, just the most important information. The tool is normally Microsoft Excel. That's the most useful tool that people use to build financial models. And of course, we use a set of assumptions in order to drive the financial model. Well, what's the benefit of building a financial model in the first place? Firstly, historical information is derived from accounting packages, and when we're managing a business, when we're a business owner or a manager, we need to look at information of the future. What's going to happen in the future? What's the effect of the decisions we're making in the future? They're key to any finance decisions. Any bank wants to know future cash flows in order to determine whether a company can repay loans. It's key to any major capital investment. Investors want to know whether we're going to get an adequate return on capital. And then in anyone wishing to sell a business and wishing to buy a business, it's very important to understand future profits and cash flows. Who would use a financial model? Firstly, managers of companies. They want to understand the effects of their decisions. Investment analysts want to understand future earnings and dividends in order to make investment decisions. Financiers want to predict the ability of a company to repay a loan. And potential investors in a company. They want to understand existing profits and cash flows and future cash flows and profits. What's the potential of a company? So what's the upside if we decide to buy a company? How do we build a model? Well, firstly, we gather key financial information. We cannot look at all the information in a company. We need to summarize information. For example, we cannot put sales of every single product into a financial model. We would summarize it, look at it by product group or category. So here's an example. We have an imaginary pet food company that's selling dog food and cat food, and we have extra large dog food, large dog food, medium dog food, and so on. In the financial model, we would never put that level of detail into the model. We would just summarize the information into dog food and cat food. Typical key information we would look at. So we'd go back into the accounting records, we'd have discussions with the business managers. We would then look at the key financial information of the last few years. What were our sales? The number of units we sold, or the monetary units, so the dollar unit or whatever currency we're working in. What were the costs, product costs? What did it cost us to make the product or to sell the product? What variable costs do we have, such as sales commissions that are dependent on sales volume or sales value? In other words, the more we sell, the more it costs, because the commission is dependent on sales. Then we have fixed costs, which are independent of sales volume, and those would be typically fixed payroll costs, rentals, and costs like that. Other key information, we want to know sales growth. So how well has this company grown in the past? What kind of gross profit margins does it make? Inflation rates, interest rates, tax rates. Those are key inputs we need to know. Then we need to start determining our assumptions in the model. So how are we going to grow in the future? What will our gross profit margins be in the future? Our variable costs, so our sales commissions or royalty costs. Fixed costs, we would typically look at our current cost structure and then look at inflation or other cost pressures that would cause those costs to rise in the future. Is there any planned capital expenditure? What changes will we have in the future? Are we going to move premises? Are we going to hire new staff? Do we anticipate the economic environment changing? Would interest rates or tax rates change in the next few years? And then quite important, there are the constraints to the model. So any business has constraints. No business can grow indefinitely. You might be able to grow 10% or 20% using your current factory or your current premises or your current store space. But beyond that, you would need to invest more capital to buy a new factory or to start new stores or to start a new division. So what's the limit of this business? Here's the modeling process. We gather our key historical data, determine our key ratios, then we determine our assumptions. And then here's something quite important, is to separate these three things. So the inputs must be separated from the calculations, and that must be separated from the outputs. The user will typically put in their inputs, what's the sales growth, what's the margin. We will then do the calculations on a separate sheet, and then finally on a third sheet, or fourth sheet, we'd have things like our income statement, graphs, balance sheets. Finally, we need to audit or check the model. Does the outcome make sense? If we're saying the company has doubled in size, does that make sense relative to the assumptions we've put in and relative to what we know about the business? If it doesn't make sense, we then need to go back, look at our assumptions, look at our calculations, and look at our outputs once again. So this is an iterative process. Once we're satisfied that the outputs are making sense, our calculations are sound, and we've made reasonable assumptions, then we have a sound financial model.